Alrighty. Well, hello everyone, and happy Turkey Week. It's not quite Turkey Day yet, but it is Turkey Week, and I hope everyone's excited for all the joy that we're going to experience on Thursday and all the trans fats that we're going to experience on Thursday. But we're allowed to do it. It's one day of the year, and it's time for us to give thanks. So we'll give thanks by eating, of course. Um, but thank you all so much for joining this session today. My name is Luke, and I am actually a member relationship manager here at Collective. And Collective, you can essentially think of us as your all-in-one back office solution, for your small business. We will set up your business, form your LLC S corp. We'll handle the payroll situation throughout the year. We'll handle your monthly bookkeeping, your estimated tax deposits, tax support year round, and tax filing at the end of the year. And we will do this for a very reasonable fixed monthly price or fixed yearly price if you choose to go that route. But today, we actually have a session called Tax Tuesday, and it's an AMA. It's an Ask Me Anything session, regarding taxes, regarding, business finances or best practices or anything like that. So, give me your questions and I'll do my best to answer them. And Silly Sparkles. Well, first of all, I love the name. You do seem sparkly. They're 9 months in, and it's been a fabulous experience with Collective. Well, thanks so much for the kind words, and I'm really glad to hear that. And before I go on with the show, or not the show, the session here, I'm not famous or anything, believe me. It's important to note that this is just information. Don't consider it, official tax advice. Don't consider it legal advice. I'm not an attorney. Just consider this information. The tax code, it's extremely complicated, and it's usually best to, consult with a CPA or some sort of tax professional that knows your specific situation before you act on any of this information. So, just keep that in mind. But with that being said, I think that we can go ahead and get started here with these wonderful tax questions. Oh, okay. Well, the first one is, what are the Black Friday opportunities with Collective? Well, the Black Friday time period, like a lot of other companies, is when we run our biggest sale of the year. And usually, when you first come on board with Collective, you have to pay your first month's dues, which are typically $349, and then you need to pay a business success fee, and that's an additional $199 along with that too. So, what is that? Doing the math, that's close to $580 or something like that. If you sign up by the end of this month, we'll actually waive your first month, and we'll also waive your business success fee. So essentially, the Black Friday deal is you can sign up for Collective for free, essentially. And we'll go ahead and get started on forming your business. We'll go ahead and get started on the accounting for that month. So it's really important. If you want to take advantage of that deal, just make sure to schedule a call with an advisor and sign up for the service before the end of the month. And you can do that online. You can do that on the Collective website, collective.com. You can send us a message on Instagram, on one of our social media accounts, and we'd love to link you up with an advisor so you can have a discussion and have a call. How can entrepreneurs take advantage of Black Friday deals from places like Target, Best Buy, etc.? Well, really, how entrepreneurs can take advantage of that is that there's any sort of equipment or business purchases that you need that you can get a discount on. That's the advantage of Black Friday. But really, Black Friday doesn't have because you're getting those deals discounted. It doesn't really have much to do with your tax situation, because when you buy things for your business, certain things for your business, it's a write off. You can write it off, right from your income as a business expense. And if you get a really good deal, like, yes, that's a great deal, but of course, it's less of a business write off than if you were to buy it, at full price, outside of the Black Friday deal. But that's okay. That's still better. It's still better to pay less for a business purchase than it is being able to write off more from your accounting. Because a lot of people, I'll hear a lot of people say, well, I need to find, business write-offs. I need to find, ways to reduce my, net income of the business. I need to find some things to write off. Now, things that you've already purchased that you need for the business, of course, you should account for those. You should make sure that you write them off in your books. You should just generally make sure that you write them off. But I would advise against going out and finding additional expenses that you do not need for the business just so you can pay less in taxes. Because if you think about it, it doesn't really make sense. Because, like, so for example, let's say that you want to find a $3,000 write-off or something like that. Let's say that you want to write $3,000 off from your account. The only way to do that is to go out and find something random that you could use for business that costs $3,000. So let's say that that's a computer or something like that, and you go out and buy it. You don't need that computer. The computer you have is perfectly fine. You've just bought a flashy expense for the business, which is fine. But what's happened is, yes, you've saved taxes on that $3,000 because that's $3,000 of your money that you're no longer going to be taxed on. If you write that off. So, you might, and this is a complete spitball. I have no idea how much that would save you in taxes. But let's say, it might save you, I don't know, that could save you, $500 in taxes or something like that. But you've spent $3,000 on something that you don't need in order to save $500. Doesn't make any sense. You're worse off financially because you spent your money on something that you do not need in order to save a lesser expense. So, it's just important to think of it like that. Is if you've bought everything that you need for your business in terms of business expenses, don't go out and try to find additional expenses just to save on taxes. Because the tax bill that you'll save on will very likely, almost 100% likely, be less than the expense you bought in the first place. So it's just important to think of it that way. I know that was a big rambling answer, but hopefully I didn't confuse you very much. Do you guys do S corp taxes? Yes, actually, that's what we specialize in. We're an S corp company. So if you came on board with us and you're not already an S corp, we will turn you into one. We'll file the paperwork to have your LLC, if you already have one set up, taxed as an S corp, and we'll file that paperwork with the IRS. But also, if you come on board and you don't even have an LLC yet, we will also form that LLC as well. Before we make your S corp election. And so yes, we'll certainly file those taxes. And that usually happens at the end of the year that you become an S corp. The S corp tax return is due by March 15th of the following year. So let's say that you became an S corp, sometime in 2024. If you join Collective, sometime before the end of the year, we would file your S corp tax return for that year. What if I already have a business? That's totally fine. And what kind of work is done when you come on board kind of depends on what sort of business you have. But let's say that you only have an LLC. At this point in time, it's essentially too late to go ahead and elect. It's too late for Collective anyway to go ahead and elect that S corp tax status for tax year 2024. It's just too late in the year for us. Now, there are certain accountants, there are certain tax professionals that will backdate it to the beginning of this year. They might even backdate it, before this year, the S corp tax status. But just keep in mind that can be extremely expensive. It, the IRS is going to look at that pretty closely. So you'd only want to do that if you were absolutely sure you needed to do that. So usually, if someone's making around 100 grand or so, it's typically not even worth it at this point to go back, to backdate the S corp election. But like everything with taxes, that just kind of depends. Of course, it depends on your situation. But if you have an existing business and you have an LLC, if you join now, we'll go ahead and elect your S corp tax status to start on January 1st of 2025. and we'll kind of we'll prepare the books to get ready for that, and just kind of get you prepared to go into 2025 smoothly as an S corp. Now, let's say that you're already an S corp. You've already formed your S corp, you made the S corp election. If you come on board with us, we'll actually help you go back and kind of clean up the books for 2024. Make sure everything's finalized in an S corp context for 2024, and then we would file your S corp tax return by sometime next year, of course. And then let's say that if you're just a sole proprietorship, like let's say that you don't have a business, any sort of business entity set up, we'll go ahead and set up that LLC for you. Get it ready for 2025 so we can make your S corp election and go from there. How can an S corp election save you money? Well, I'm glad you asked. That's the entire point of all this, right? Essentially, one of the big reasons why you'd want to elect the S corp tax status is to save on the self-employment tax, specifically. And the self-employment tax, it's a flat tax rate of 15.3%. And really what it is, like that 15.3% is just another word for, or the self-employment tax is just another word for Social Security and Medicare taxes. That's what that 15.3% represents. And I believe that 12.4% of it goes to Social Security, and the other 2.9 or 3% goes to Medicare. And what's interesting about that tax rate, the self-employment tax, the Social Security Medicare tax, is that's a tax rate that you pay even when you're a W-2 employee, even when you're employed by someone else as a W-2. That tax rate is charged on your W-2 salary. But the difference, though, is when you're employed by somebody else, your employer, whoever's paying you this W-2 paycheck, is required by law to pay you half, or I'm sorry, to pay half of those taxes for you. So, you pay 7.5%, and the business pays 7.5%. So the Social Security and Medicare tax is cheaper when you're an employee because you're getting half of it paid for you. When you're self-employed, though, there is no employer to pay half of it for you. You're on the hook for the entire 15.3%, and it hurts. So it hurts quite a bit. And the thing about that, or that's where the S corp comes in, is what I'm trying to say. And so just to kind of put that into perspective, let's say that two people are making $100,000, and one of them is a W-2 employee, and the other one is a self-employed person. The W-2 employee is probably only paying around $7,500 in taxes, or in the Social Security and Medicare tax, because their employer is paying the other half. They're paying the other $7,500. When you're self-employed, though, this person is paying closer to $15,300 because of the full tax rate. How the S corp helps with that is it allows you to pay yourself a salary. When you file that S corp election paperwork, you essentially become a W-2 employee of your own business, of your own LLC S corp. You become employed by the business. And since you're employed by the business, of course, your business will pay you a salary. It'll pay you, a W-2 wage, just like you'd receive if you work for someone else, like as a W-2 employee. So, and now only that salary amount is subject to the self-employment tax. And the rest of your money are business profits, are the S corp profits. And that money is still yours. You can still pay yourself this money in a certain way, but that chunk of cash is no longer subject to the self-employment tax any longer. So, for example, let's go back and use the example of someone making around $100,000. Let's say that someone's making 100K and their business in total is making 100K. And, for whatever reason, this person believes that a $40,000 salary is a reasonable salary for themselves. So now only that 40 grand is subject to the self-employment tax, the 15.3%. The other 60 grand, or, just the rest of your money, outside of your salary, the technical name for that money are distributions to yourself. And you can kind of think of that money, like conceptually speaking, you can kind of think of it as dividends. Some people will use that term. They're not dividends, but it just conceptually you can think of it that way. Long story short, that 60 grand is no longer subject to the self-employment tax. And the beautiful thing about it is that you can still take distributions whenever you'd like to. You can still transfer that 60 grand to yourself and spend it personally. Invest it in stuff. Go out to eat. Take care of your kids. Whatever you want to do with that money, you can do, but it's just no longer subject to that tax rate. So, just kind of doing some quick math, someone like that is probably saving between $9,000 and $10,000 going the S corp route. Can you reinstate an LLC if it's inactive? How much would that be? Well, you can in certain states. You can reinstate the LLC, and usually you have to just go to your Secretary of State website and kind of follow the instructions. Every state has a little bit different instructions. Every state has a little bit different amounts that you need to pay to reinstate it, and it kind of depends on why your LLC would become inactive. A lot of times it's because you haven't paid your annual renewal fees or biannual renewal fees. Like some states only, I believe only New York actually, only requires you to file an annual report and pay a renewal fee every 2 years. So what they'll have you do is they'll probably have you pay a reinstatement fee, but they'll also have you pay any sort of past renewal dues that you haven't paid. Does Collective file quarterly taxes as well? Well, we will calculate your quarterly taxes for you, but you're going to actually have to be the one to file them or pay them. Because the thing is, we have access to your bank account in the sense that we're going to electronically hook up your business accounts and run your accounting month to month. So you won't have to give us, actual receipts or anything like that. But we have access to your accounts in that aspect, and in the sense that we can see transactions that come through and the information associated with them. But we don't have the right to actually reach inside your account and spend money on your behalf. That's just not very safe. Um, so you would still like any sort of tax payments that need to be paid to the government. You would actually have to pay those payments, but that's very easy. Silly Sparkles has a very good question. Can you settle a debate between me and my husband? Can we buy coffee and donuts for our office as a tax write off for our S corp? No, you can't. So it's very likely that the IRS would consider that a personal expense. Because the thing about that, usually the only way that you can write off food or coffee or anything like that is if you are taking a client out or a business partner out. And the only reason that that sort of expense is happening, or that dinner or coffee date or eating some donuts, if the only reason that is happening is because of a business official meeting, then you can write half of that off. Can't even write the full thing off. You can write half of it off. But no, I do not believe that you can write off coffee or donuts for your office. Good question though. So, like for example, it's kind of similar to where there are a lot of people that think if they just go to a coffee shop and are thinking about the business or working on the business at that coffee shop, they can write off the coffee that they pay during that session. No. Drinking that coffee is you're doing that in a personal capacity in the IRS's eyes. I'm pretty sure our collective accountant is going to tag our donuts and coffee purchase this month and ask us to explain. Probably. Probably so. But that's okay. That's why we're here. Great question. And I could see why, like, don't get me wrong. I could see why some people would think that those sort of expenses are deductible expenses. And I'll kind of give you another example of something that's even more surprising. Nowadays, of course, with social media and whatnot, we have a lot of sort of subject matter influencers to where they might be knowledgeable in business or investments or some sort of craft, and they present themselves on social media, and that's their business. And a lot of them, in order to look fabulous, of course, like they'll get their nails done, they'll buy really nice suits, they'll get their hair done, and those are not deductible expenses. And the problem with that is I totally understand why, and a lot of people think that think that those are. They are not. And a lot of these tax influencers and people online that you see share these sorts of information, like write this off, write that off, write that. They're doing a disservice to people because they're wrong. They're just simply wrong. The IRS does not accept that because you want to look good for your social media presence, then that therefore means that all those expenses are deductible. They're not. Those are you if the IRS has something called a business, essentially a business exclusivity test. And you're really very generally, you're only supposed to write those things off if you're only doing it for the business. The thing is, if you're getting your hair done, you're looking fabulous when you're walking down the street in your own personal capacity. The IRS wouldn't consider that um, a deductible expense. If you're buying a really nice suit, a $3,000 suit to do your Instagram stuff, you can. It's possible for you to wear that $3,000 suit off of Instagram or off of your social media. Therefore, the IRS does not consider that deductible expenses. Now, my personal opinion, I do believe that a portion of those should be deductible, but the IRS doesn't care what I believe, or they don't care what anyone else believes. They care about what tax law is. And tax court cases have shown that they do not accept those sorts of expenses as being deductible. So keep that in mind. If I have my kids, if I have my kids on my S corp payroll and I get them gifts for the holidays, can I write off as can I write that off as an employee gifts? No, because those are the IRS would very likely see those gifts as being made in your personal capacity. Great question, though. A lot of people talk about S corps, but what about C corps? It's it's pretty rare, especially a small business owner. It's pretty rare that someone needs to be a C corp. And the difference about C corps and S corps and LLCs and whatnot is that C corps are not pass through entities. They are official, separate corporate entities, and typically they're subject to the corporate income tax. So let's say that you're making $100,000 and you have a C corp set up. When the C corp itself makes 100 grand, it's taxed the corporate income tax on that 100 grand, and then you're taxed again when that 100 grand gets paid out to you in W-2 salary and as dividends or something like that. So it's taxed twice. It's taxed at the corporate level, and then it's taxed at the shareholder sort of slash employee level, which you would be as owner of the C corp. You'd probably be an employee of it as well, and you'd be a shareholder that got paid dividends and whatnot. All of those are taxed. Now, don't get me wrong. There are ways to legally set up a C corp and structure the accounting to where the C corp itself has a zero net income. There are ways to do that. Um, but it's usually pretty complicated and you usually needed a tax attorney or a CPA to handle it for you. It's just pretty rare that someone would need to be a C corp. But it also just kind of depends too, because there are some restrictions on S corps, especially when it comes to ownership. And one of the big restrictions is you can only have up to 100 owners, um, or 100 shareholders in an S corp. You can't have any more than 100. So let's say that you're involved in fundraising. Let's say that if you ever want to go public and issue the sale of your stock or the ownership of your business to thousands of people, then you couldn't do that as an S corp structure. You would a tax structure. You would need to have a C corp structure, probably. All right. What's it? Could you explain a partnership for me? What does it mean when someone is a partnership? A partnership is it's a lot easier than it sounds. A partnership is essentially a multi-member limited liability company. It's a multi-member LLC. That's essentially what a partnership is. And an LLC, like a limited liability company, is essentially just a structure that you set up with your state of residence, usually. And you file these articles of organization with your Secretary of State's office. And it forms a business structure, which is called a limited liability company. Now, a partnership is essentially just a limited liability company with two or more people listed as owners. And then when you do that, when you form that with the state, the IRS will automatically have you be required to file a partnership tax return. It's called a Form 1065, actually. And the difference between partnerships or multi-member LLCs and single-member LLCs is single-member LLCs they're actually treated as disregarded entities as a in tax purposes. So the IRS doesn't require any sort of special tax return for an LLC. All that information is reported on your personal tax return. But partnerships, all that information is first reported on your partnership return, your Form 1065, and then that money will flow, or whatever is reported, will flow back to your personal return, so you can file it. And I have time for one more question here. I actually have to jump pretty soon and hop on a call with a collective member, actually. How do S corps work with retirement accounts? Okay, that's a great question. So really, there's two types of main retirement accounts that are relevant for an S corp. One is a SEP IRA. It's essentially a self-employed pension plan, is what it is, and the other one is a solo 401k. And they work a little bit differently depending on which one you have. With a SEP IRA, you can only contribute as the employer. The employer can contribute up to 25% of your W-2 compensation. So if you're an S corp and you pay yourself $100,000 in W-2, the S corp itself can contribute or deposit $25,000 into your SEP. If you have a solo 401k, it works a little bit differently. You can actually contribute up to $23,000 as an employee, and then the S corp itself, the employer, can contribute up to 25% of your compensation as well. And I'd explain more on that, but I actually have to run. I've got to go talk to a collective member. But it was a pleasure, like it always is every week. I would encourage you to schedule a call and take advantage of that Black Friday discount and see if you need to be an S corp.